gentlemen, welcome to the final day of the Atlantic Dialogues. Our first session will begin shortly. Please take your seats. Ladies and gentlemen, the session will now begin. Please take your seats.
More than a decade has passed since the global financial crisis, but the age of unconventional monetary policy has not ended. More recently, monetary policy has eased in 70% of the world economy. Negative yielding debt has reached $15 trillion, and financial conditions could ease further. As tends to happen when the search for yield persists over long periods, financial system vulnerabilities have continued to build. Where are the key rising vulnerabilities in the global financial system? To what extent has heightened trade and policy uncertainty affected financial flows? What should policymakers do to address rising financial vulnerabilities? Are we on the verge of the next financial crisis?
Ladies and gentlemen, please welcome to the stage our moderator for the next financial crisis session, lead presenter of Newsday at BBC News, Kasujja.
Good morning.
Bonjour.
I expect a very responsive audience. So you're going to work with me, aren't you? This is an area, secret between me and you. This is a bit too complicated for me, so I will rely on your input to make this work for all of us. Thank you very much for coming in. I'd like you to meet my panel. My panel is very distinguished, and I'd like to introduce it to you without wasting any more time. Let's meet Professor Ayadi. She's an economist and also an international expert on inclusive and sustainable socio-economic models, financial architecture, and stability. Let's give her a round of applause as she comes up. She's also professor at Cass Business School and a member of the Center for Banking Research at the City University of London, and she's the founder and president of the Euro-Mediterranean Economists Association. Another round of applause for her. Otaviano Canuto is a senior fellow at the Policy Center for the New South, previously known as OCP Policy Center. He's also the principal at the Center for Macroeconomics and Development and non-resident fellow at Brookings Institute. Let's give him a round of applause as well, ladies and gentlemen. And he was a former vice president and executive director at the World Bank, executive director at the IMF, president and vice president at the Inter-American Development Bank, and a very accomplished man indeed. Next, I'd like to introduce you to Harinder Kohli. He's the current editor of Global Journal for Emerging Markets Economies, and he's also served some 28 years in various senior managerial positions at the World Bank, in private sector in India, and also in France. He's written extensively on the emergence of Asia, Latin America, Africa, and other emerging market economies, financial development, and infrastructure. And last but not least, Edward Scicluna. He is the Minister of Finance of Malta. He's been doing that since 2013, and is a former chairman of the European Investment Bank Board of Governors and the vice chairman of the European Bank for Reconstruction Development. And he has served as a member of the European Parliament and in the capacity of Vice Chair of Economic and Monetary Affairs, and also a member of the European Statistical Advisory Committee, professor and former head of Department of Economics, University of Malta. This is a really, really distinguished panel. Don't you agree? Yes. Let's give them a round of applause, ladies and gentlemen. And again, feel free to ask questions, feel free to put up your hands. This is a conversation, an engagement. Amongst you are experts who understand this stuff more than I do, and I'm here to facilitate a conversation. So we are going to get started, and I'm going to start by asking you, Professor Ayadi, just share your thoughts about the vulnerabilities that we're talking about at the moment. Would you say that, where would you say the rising vulnerabilities are?
First of all, good morning, everybody. On a Saturday, we're discussing the financial crisis or the next financial crisis, which we don't know yet when it's coming. Most importantly is clearly the global economy nowadays is in transformation, whereby there are trade tensions, which we've been seeing them over the last few months, and actually since last year, we've been talking about those. These have increased the vulnerability in terms of multilateralism and trade negotiations between the different players, economic players. Obviously, the key point here is also we can see that with the lax monetary policy that the developed countries have been really opting for over the last few years, and since the 2008 financial crisis, this has increased dramatically the risks, in fact, the risk premiums, not only in the corporate sectors, but also in the sovereign sector. But also we've seen a tremendous increase of debt worldwide, and this is also something which has to be really very carefully assessed, because at a point in time when you have a large increase of debt, then there is a problem and the risks are huge. If we look, for example, at the corporate sector, especially, for example, if we look at China, China has increased dramatically its level of debt, and this will pose at a point in time serious vulnerabilities and risks into the global economy. But also, if we look at the low interest rates that have been now persistent over the few years, because again, this dovish monetary policy, then clearly there is an increase of risk premium, and then the investors are really pushing as much as possible to enhance the risk taking. And then, for example, if we look at the case of Europe, the commercial real estate is really increasing very much the risk. Now, at the same time, we are seeing trends at the global economy, the global regulators, whereby the banking regulation has been relaxed. There is no really the same push as it was a few years ago, where you need to increase capital ratios, and this is also creating serious problems into the financial system. The third point, which for me is key, and this is probably more medium term, is the climate change risk on the balance sheet of the financial institutions. There is a transition risk, which is coming slowly, with moving into a scenario of climate change decarbonization, so decarbonization of the economy. And this transition risk is coming quicker than anticipated, together with the physical risks, which in fact we are seeing the frequency of hurricanes and earthquakes and all of this are really going up. So it means that insurance companies will have to have hits on their reserves. It means they have to have much more reserves on the liability side. This will have some strains on them. So really I see the risk accumulating. There are some new sources of systemic risk at the global level, but then unfortunately up to today, there is no, I would call it a global institution that can really monitor carefully all these risks together. They are all fragmented, and we can see that when it hits, it will hit somewhere, but up to now, we do not know where it's going to hit and who is going to deal with it.
That's interesting. And Mr. Minister, do you know where it's going to hit?
Well, sometimes I ask myself, why are we discussing this topic? Is it because economics is truly a dismal profession? Always, we can never say we're okay, or it's always doom and gloom somehow. Or is it because it's real, or because we feel we're not yet prepared? It's not that the danger is there, but if it is there, we're not sure we're prepared. And this is, ironically, 11 years after the crisis hit. And we did so many things, and we think that the banks are stronger. We did, the capital injections, the requirements, you name it. I mean, I spent 5 years between 2009 and 2013 in the European Parliament, and we're churning legislation one after the other. We're the busiest people in the Parliament at that time. So, but still, there are so many the landscape has changed, so many new things, as has been mentioned, technology, migration, climate change, on top of what we have. So I think it's an uncertain period. We're wobbling, and
Talk to me
therefore
about migration.
We see dangers, wherever they lurk. And when you're not prepared, then it becomes a real danger.
Yeah, let's talk about migration for a bit. Just could you expound on what you're trying to say there?
Yes, I mean, migration is an international phenomenon that existed for many, many years past, but somehow, especially in Europe, where I come from, we are not prepared. It's not managed. It's unlike Australia, US, and Canada in the good old days. Europe is not prepared for it. So you get wave after wave. It's like a tsunami, and you panic. Merkel paid a very high price when she tried to be more humane and understanding, but she paid a political price for that. So yes, migration, especially in Europe, we haven't, and even the US, but anyway, we haven't come to terms with it. We haven't managed it properly, and this again is very ironic because in Europe it's an aging society. There's a big demand for labor, and still, so many walls are being built, especially in the eastern part of Europe. It just goes to show, and there's no burden sharing as well in Europe. I mean, whoever is on the border, like Malta and Italy, will have to bear the brunt, and that's not really fair. So it is a big issue, causing Brexit, the populism and the right. I mean, migration is always at the top of their concerns. So it is a concern.
And again, I wonder what has the direct impact been on Malta's economy, and also factor in climate change and talk about that a bit more. Let me hear how you've been affected.
Very short. We are the exception because it's a very fast-growing economy. For 7% each year for the last 6, 7 years. So, and Malta, there's a limit. It's a small island with a small population. So, were it not that we are part of the EU, with an inflow of labor taking the jobs which are in demand. So we have now 25% of the labor force is from outside Malta. 50% is European and 50 from 100 or 120 nationalities from around the world. No, we're quite easy with them, with the phenomena that we understand you can't grow and you can't have the standard of living were it not for external labor who comes as partners joining you in the initiative. So we don't suffer from that phenomenon.
Yeah, let me then turn to you now. Kohli, what are you seeing at the moment?
Well, first let me say I live in Washington. And so let me try to give you a global perspective because that's my work. And to go back to the topic of financial crisis, so I think we should step back and look at it from a longer term perspective and look at recent history of financial crisis and what we have learned with globalization of financial systems. One, that there's a history of financial crisis occurring and reoccurring, and they're becoming more global. And they come back roughly every 10 years or so. And they're becoming more and more global and deeper and costly. What we know is that they happen. You don't know where they will originate.
But not China? You can't say China at the moment.
They could be China. They used to be southern core of Latin America. There they went to Asia and they spread. And then they happened 11 years ago at the very core of the global financial system in the US. And people had not imagined that it will happen in the very core of the global financial system. And they're more painful. And it is not possible to predict, even though the professor outlined where the risks are. It's now 11 years from the last crisis. So the history teaches us it may happen again. But we don't know where it will happen, but the risks are there. That's the first lesson we're learning. The second thing is that even though, as the minister said, a lot has been done, in my view, not enough has been done, including on the issue of accountability. The world paid a tremendous amount of price, not only in the US, in the world economy. And as Mrs. Lagarde said, reportedly, because I was not there when she said it,
Yeah.
even though the world has paid a tremendous price, not a single senior banker ever went to prison. In my view, the global monetary system has not yet been fully reformed. The eminent persons group of G20 had a tremendous opportunity to fix it. But in my view, they failed. It was a golden opportunity which has been lost, including reform of the IMF. The IMF is, in my view, not yet equipped to handle the next big global crisis. So if the crisis occurs, we don't have the tools, in my view, to fight it. Unfortunately, also, the G20 will not be capable, unlike 11 years ago, in terms of leadership, in terms of consensus. The tools are not there. So the big message that, in my view, we have to learn, because prevention is cheaper than cure in this case. Individual countries will have to take actions themselves.
Dans les pays originaux, il va falloir qu'une action soit entreprise au niveau national au lieu de compter sur l'expertise internationale, car les solutions pourraient être mises en œuvre rapidement. Donc les pays individuels devraient en fait penser d'eux-mêmes, y compris dans la région du Sahel, parce que la crise deviendra de plus en plus exacerbée.
To ask Mr. Canuto, who knows the IMF very well, whether it's actually indeed true that the IMF is not prepared for the next financial crisis. And then just go ahead and tell me what your other thoughts are.
Right. It is because, in fact, as of today, nobody is perfectly apt to answer promptly to whatever be the place for the next financial crisis. And Professor Harinder is quite right when he observes that the environment is not conducive to cooperation as we had after the global financial crisis. But I want to give a step back, trying to provide my views, my answer to a question that is also important. Harinder is fully right. No one can anticipate fully where the next financial crisis will come. Otherwise, it would be avoided. But
And we'll be much richer if we knew where it was coming.
That's right. But it's worth trying to pinpoint which, if any, are the vulnerable spots, because some macroprudential policies can be taken to try to avoid. And we have some idea. And I'm going to tell you the following. As we speak, we are already ongoing over a big liquidity crisis in the repurchase agreement market of the U.S. On Thursday, while we were starting our Atlantic dialogues, there was a big announcement by the Federal Reserve Bank, which is a very significant one, revealing that there is something more of concern underlying. Now, which are the vulnerable spots that one can, let's say, at least most analysts have pointed out? China has been mentioned, but I must confess that among those who don't believe China represents a systemic risk, because it's self-contained, it has huge saving rates, the fiscal position allows, with some difficulties, but they can even bail out their SOEs, which doesn't mean that they will not have defaults. We had a default of a state-owned enterprise this week, so it's happening, but not systemically. But people have also referred to the levels of indebtedness of the non-financial corporate system in the US and in Europe, but there are mitigating factors. These companies are still full of cash and so on. They use the issuance of corporate debt to swap for shares. The institutional investors have been obliged to search for yield because their liabilities, pensions, insurance, and so on, oblige them to look for some sort of remuneration compatible with their liabilities. They have been delving into riskier and illiquid securities and so on. But none of this may have, let's say, a dramatic outcome as the thing that suddenly happened on September 17th, when the repurchase agreement, secondary market, the secured market in the US, one day suddenly had a sudden stop. And we're talking about $1 trillion that are rolled over on a daily basis. And for this to function normally, the rate of interest cannot be very far from the federal funds. And on that day, suddenly the banks said, did not offer the treasuries necessary for the market to function. And the interest rate went up from 2% to 10%. It was a disaster. The Federal Reserve Bank was obliged to introduce emergency acts, injecting $75 billion. And guess what? 3 months later, the Federal Reserve Bank has the emergency ceased to be emergential and became permanent. And that's why on Thursday, while we were here opening our discussions, Jeremy Powell was announcing a package that amounts to $500 billion given not to the banks, it's to the repurchase market, the repo market, which is comprised by the rollover on a daily basis of securities held and issued by hedge funds, by institutional investors. Not talk about bank. The banks seem to be fine. Well, you had the regulation post-crisis, so they are tightened. They have to maintain their liquidity cushions. But the point, as highlighted by the Bank for International Settlements on its quarterly report last Sunday, is that 10 years of quantitative easing, 10 years of very unconventional monetary policy have changed dramatically the structure, the composition of the financial markets, with the development of shadow banking and other structures, the functioning of which nobody can claim to exactly know by now. That's what the BIS said.
Right.
And we have gone through this liquidity crisis. So we are in a liquidity crisis, which has not become systemic, has not become a solvency one because of the action of the Federal Reserve. But the point to make is that we are dealing with things that nobody can claim to understand exactly right now.
Fascinating stuff. Anybody else with thoughts to add to that at all?
I just want to add, I mean, another fear is that we are very low on firepower. In other words, we've used so much monetary policy. I mean, we're in negative interest territory, and we fear that we're out of ammunition, so to speak. And there's always, at least a new tug of war between the European Central Bank telling governments, now it's your turn, do something on the fiscal front. But again, there's a big reluctancy in Europe, especially from Germany and Netherlands and the rest, that they wouldn't want to use their surpluses to stimulate the economy from the fiscal. That's a reluctance. So again, we rely on the European Central Bank, and the European Central Bank, I've done what I can, Drug has said it, do what it takes. But now, if ever there would be, a crisis, we're fearing it more than before, because we're lacking the instruments and, as I said, the firepower.
I agree with that, if I may add. And that's what I meant, that the eminent persons group of G20 had not really tackled the real problem. The real problem, in my view, is that the world is awash with liquidity, huge amount of liquidity, and it's not really related only to what the central banks have done in terms of loose monetary policy since 2008, 2009. It really is related to the private sector flows across national borders by private banks. Massive amount, trillions of dollars of money going across national borders by private sector. And the global monetary system is simply not able to manage that. And certainly the IMF is not equipped to do it.
Yeah.
The IMF was really created originally to handle imbalances in trade, not capital flows.
Fascinating.
And that needs to be fixed. the national central banks are created, they're regulating national banks.
So how does that get fixed? How do you sort that out?
That's why you need fundamental reform of the global monetary system.
Yeah, Harinder, if I may just add something, is right. We need a multilateral, some form of cooperative interaction among authorities, not necessarily the IMF. And I will say why. I was talking about the repo market in the US, but let's keep in mind that the non-US banks all over the world use that market to connect, to organize their foreign exchange swap, their hedge. So, and we're talking about $1.4 trillion. So if something collapses on the repo market in the US, that has ripples over the non-US banks that operate with dollars everywhere, in Nigeria and everywhere. You have to have the monetary and financial regulatory authorities working together with disclosure and so on, so as to step up the regulatory, the macroprudential regulation policy necessary to deal with that. It is not the IMF.
It doesn't have to be IMF, it has to be somebody. The global system, one needs to look at it, how to handle this liquidity in the world, which is going across national borders, and there's a need to look at the whole system. And that opportunity has been missed. It needs to be re-looked at again.
So what are you proposing as a possible solution? Look at it how? How do you sort it out? How do you fix it? Is there, what do you need to put in place?
Well, that's why this G20 eminent person group was created. And they looked at it, and I think one needs to go back and look at the whole global monetary system, because there is huge amount of liquidity. You cannot have individual central banks work on their own. I think all of the central banks need to coordinate, sit down and talk about it. It's BIS, there is IMF, there is European Central Bank, there is Central Bank in Japan, in the US. It's the whole system. And they need to coordinate.
Yes, please,
there is one point, I completely agree with this view, but first of all, we need to understand after more than 11 years how much risks the central banks have in their balance sheet. Because there is a quantitative easing over 11 years now. So what is important is also to understand what types of risks they're hiding in their balance sheet. First, disclosure. So to understand what we are talking about, first we need to understand what is the amount of risks they're sitting in the balance sheet. So that's first of thing is disclosure. So as much as possible to understand on which they are going to collaborate for which solution. Because again, the risk is mounting slowly. We're talking about systemic risk. It can be quantified. Up to today, you do not have a proper quantifications of those systemic risk building in the market. There is a monetary problem that is clear, especially when the central banks, they do not have the capability nowadays to reduce more the interest rates. It's already negative in Europe in some instances. And even some banks are already applying some interest rates on savings, on deposits.
Right.
And this is, in my view, very dangerous if it continues. So on one hand, we have very little information about what's going on the balance sheet, what is the amount of risk, and on the other hand, of course, the risk is mounting, and we are touching a liquidity crisis.
Anybody with any thoughts at all in the audience? Okay, very good to see hands go up. Where are the microphones? Let's get ready to distribute the microphones, please. Let's start with the lady over there, and then we'll come to this gentleman here. What do you want to say, madame? Please introduce yourself.
Merci, je vais m'exprimer en français. Je suis désolée.
Thank you. I'll speak in French. I apologize. You did actually diagnose the state of the world. And your diagnosis cannot be criticized because you did actually focus on the excess of liquidity or the surplus of liquidity with a drop in the top interest rate, and particularly if you have a negative interest rate. So from that point on, you do have economists who do endeavor to provide solutions and who fight for this new monetary theory, which states that as the states can never be declared bankrupt, it would be profitable for the international trade and economy to finance investments by borrowing further, and that debt, both that subscribed to by the states and by corporations, was exaggerated. There is a greater flexibility required for this perception, and therefore, even though countries are deep in debt, we should take advantage of this historical opportunity created by negative interest rates to finance infrastructure and to finance energy transition. And since this is long-term financings, they can only inject growth as well as a new impetus for investments. What do you think of the solution put forth by these economists?
This gentleman over here, please. Let's move the mics as quickly as we can. Yes, sir.
Thank you, Hung Tran from the US. One quick comment and one question to the panel. The comment is that you refer to the global monetary system. In my view, there's no such thing as the global monetary system. There's a dollar-based monetary system which everybody uses. This is different from a global system. The problem is that such a system is inherently unstable and unsustainable, to the extent that more and more non-US banks use the dollar to finance their activities. Right now, they have liabilities of up to $15 trillion, $15 trillion, rolled over on a short-term basis. They don't have a lender of last resort, which only the Fed can do. And the Fed, thanks to financial regulatory reform, is severely restricted in helping banks, let alone non-US banks in crisis. So a crisis is happening, waiting to be happen, and we really don't have
Is it happening or is it waiting to happen? Where are we?
It is waiting to occur, and we don't have a means, the tool to deal with it. The question is, smaller question, sub-Saharan African countries or the least developed low-income countries. Many of them have a higher level of debt now compared with the level of debt they had before the previous debt forgiveness exercise, the HIPIC one. So what do you think should be done about them? And what should really be done to make sure that going forward, the inefficiency and corruption associated with using the debt will not occur, so that they don't run into this recurring debt crisis?
That's an interesting question, because there are people suggesting that it's time for HIPIC 2. I wonder if you want to pick up on that.
I would like to tackle the modern monetary theory question, which is very interesting. And look, I will tell you where I and many agree with what is said and what we disagree. There's nothing modern in modern monetary theory. It's, let's say, a radicalized version of ultra-Keynesian policies that tends to, let's say, to underestimate the limits given to economic growth by the supply constraints. Of course, if you are in a situation in which there is very much lack of labor and so on, then the old, simple Keynesian principles apply. Where the modern monetary theory got something right was a experience that we saw during the euro crisis. During the euro crisis, a phenomenon took place. Although the UK had, at the time, a debt to GDP ratio much higher than Spain, the UK was able to fund itself at very much lower rates. And the best explanation for that was that the UK could issue its own currency. So even if there was an inflationary risk, the default risk would be lower than the case of Spain, which had abdicated of the capacity to issue any currency. But then the guys generalized that to lead to the conclusion that the levels of public debt doesn't matter because a certain country that has a convertible currency can pay out everything, issue money, which is an extreme oversimplification. Having said that, one way to try to go beyond the exhausted unconventional monetary policy is by connecting fiscal and monetary policies in a way that might, for instance, BlackRock has come with this proposal of having some sort of communicating veins between monetary authorities and the fiscal authorities to guarantee immediate automatic financing of issuance of public debt associated with some special projects. And that's where the new Green Deal comes in. Is there sense for this? Yes, particularly if we, like Minister Edward, believe that one way or another, fiscal policy will step in. So we could do fiscal policy in a more organized way. But the fact of the matter is that there is no magic solution, such as print money and then we live out the crisis.
Okay, well, what about you? What do you think?
I would like to say a few words about the first comment, in fact, or the discussion, in fact. It's still under discussion, and I believe that, yes, having low to negative interest rates could eventually be transferred to the real economy. It means that, okay, as you have high interest rate or middle-level interest rate, you can price your loan in a certain way or price your investment or you price your exposure in a certain way. But then if you have low interest rate, maybe you can use it as a discounted or discounts to eventually finance long-term projects, like, for example, the climate change transition projects to move into decarbonized economy over 2030, 2050. But this means that somebody has to subsidize in a certain way also this type of projects. Nowadays, for example, some investors who are holding German bonds, they are accepting not to get certain level of coupons, or even they are losing on the principal. But why is that? We need to understand what is the underlying of this. It means that the investment community worldwide would have to have a little change in their perception about what is financial performance. You see, over many years since the Washington Consensus, the first thing is the financial performance. Nowadays, we need to rethink the financial performance and really link it to what I call community or sustainable performance. What it means? It means, okay, if you make money on a certain exposure and long-term exposure, but then at the same time you are destructing the planet or destructing the society, you have to really think about it in a certain way. And nowadays the economists, we are trying to think really how to embed environmental performance within the overall financial performance and how to accept certain discounts on that. On the second point, sir, I wanted to make a point on the sub-Saharan Africa.
Et le deuxième point dont je voulais parler sur l'Afrique subsaharienne. N'oublions pas au passage qu'il y a sur le marché de l'argent bon marché. Et les investisseurs, après tout, sont à la recherche de rendement. Tout le monde, bien sûr, est à la recherche d'un rendement. Ils veulent éviter les risques. Éviter des risques, certes. Et avec la capacité...
I don't know. This is the main. It means that there might be a massive default that we will see. For example, it might even start in some countries in sub-Saharan Africa, whereby their capacity to borrow has been increased.
Are there any particular countries you're thinking about?
There are many countries. I'm not going to point on certain countries because that's not the point. But then if you look at
She could call frontier market.
Yes, I call them the frontier market. But the key point for me is not is the fact that risk is being repriced in a certain way, and nobody knows what way is this. So it means that some countries, they have the capacity to borrow, some investors are going to invest in those countries, but maybe the IMF will bail out certain countries, and they are doing it.
Can I add that a little bit? To your question on Sub-Saharan Africa, I share your concerns. We've done some work on that. I personally think that in number of sub-Saharan countries, more than number, and I think IMF agrees with that, the debt ratios are worrisome. And these are particularly countries which did not adjust after the collapse of the super commodity cycle in 2014. And they kept on, instead of adjusting, borrowing more, running down their reserves. And now the debt levels are at levels which are worrisome. And countries need to adjust.
I think it's just a journalist in me, but I like to work with examples. I like to hear that this country, for example, is just about to go bust. It's about to break. Who's willing to tell me about, who studied something about a specific country and they're willing to share that?
Well, I personally think it will be imprudent to name countries because that will cause unnecessary panic. And I think just the way IMF doesn't name countries.
Okay.
And countries know them.
Okay, so I've heard that Ghana and Kenya are struggling at the moment.
Additionally, let me add something quite important in this regard, in my view. There is lack of transparency as well.
That's it.
So if you ask anyone here, or if you ask the IMF or the World Bank to gauge exactly what is the debt situation in some sub-Saharan Africa, none of these institutions will be able to.
Yep.
Really?
Yeah.
Yes.
Why?
Because part of the transactions with the private sector have not been duly registered. Secondly, there is China. The following thing, the only ones who know how much Chinese money has been lent to sub-Saharan Africa are two institutions, the Exim Bank of China and the other formal official bank. And there is not by chance a push, a complaint from the international community for the Chinese to disclose those information that they only have.
Yes, Professor.
I just wanted to emphasize on this because nowadays the international community led by the IIF, they're really pushing for more transparency on the debt market. So, and this has been a call in the previous G20 to have more transparency on the sovereign debt market. This is also an important point.
Yeah, Mr. Moore, let's get that gentleman at the back there, and then I'll come to you.
Thank you. I just wanted to make a comment.
Just introduce yourself briefly, please?
Nkosana Moyo from Zimbabwe. I'm also on the board of the Mandela Institute for Development Studies. Whilst I appreciate your journalistic enthusiasm, I think we need to also appreciate that in finance, I think what could be considered as careless treatment of information can actually cause a bigger problem.
I appreciate that.
So, yeah, I think we should just deal with it like that.
Oh, was that the point? Okay, let's give him a round of applause. Anybody else would like to? Yes, this gentleman here put up his hand a while ago. Yeah.
Yes, I'm sure, Mustafa Miblouk, I'm running a media company in Morocco. I'm sure that if you ask the question, are you expecting a financial crisis in the future? The answer will be 100% yes. And as we know, the tools used for the last financial crisis were a coordination with all the central banks to reduce the level of the interest cost from 4-5% to lower. What to do when the rates are already at the lowest? Mm-hmm. What are the tools to be used for the future from your perspective? Thank you.
Okay, we shall come to that in a moment. Let this lady ask a question as well, please.
There's a microphone.
There's a microphone.
En español.
Well, I have several questions.
J'ai plusieurs
About conservative monetary policies, and I have the impression that we were not able to reach a consensus on the Washington consensus, and it seems to have been, to be dated now, to be something from old times. And as a politician, I sometimes have the perception that in economy there is a lack of transparency, and we do not talk about, when we talk about finance, we don't talk about corruption, we don't talk about those funds that just go away, the payment to international bureaucracy to fund programs against poverty, and then the funds just disappear. I was a director of a company, the main state company in Chile, for the production of copper, and we have copper until the year 2053. This is guaranteed. What will happen after that? How are we going to innovate? That's why the comment from the lady behind me about sharing resources, talking about the world and rethinking for the next generations. I think this is paramount and key. I just wanted to say that because I keep hearing about the logic on which the international monetary institutions work, but I don't hear as much about what should be done, what is still to be done. More transparency, more regulation, other agreements. What is lacking to improve? We cannot just sit and wait for the next crisis to be announced between the big powers, and then the smaller countries are somehow submitted to the market, to the actual progress of the markets. I am not an expert, but I want to give that political point of view.
There's a lady at the back there. Let me ask the lady at the back first, and then.
Thank you. Good morning, and thank you for your contributions. That's Annette Tesfaye from IHS Markit in London. Just one point and one question. With regard to looking at the rapid accumulation of debt in sub-Saharan Africa and the nature of that debt being more commercial and less concessional, which defined the previous HIPC relief process, we have to look at the role of the lenders in that case and their engagements with these African countries. And on the African side, lack of experience in trying to procure and manage this type of debt. And so you see that there's an asymmetry in power where commercial lenders are coming forward, negotiating terms that arguably African governments were accepting based on what they think are market protocols or practices. And we've seen this play out in the case of Mozambique, where it's hard to distinguish blame, but you can see it's being investigated in the US and London based on what they consider to be inappropriate behavior. The second point with regard to the credit rating agencies and the influence that they wield there. Madame on the panel referred to how is risk being priced, but financial capital markets are using that as a bellwether as to which emerging or frontier markets they should go into. So if we're looking at that, what's informing that pricing mechanism, should we be looking at how that risk is assessed by these institutions that wield great influence?
Okay, let me come to the panel and then we'll get back to the audience. Yeah, any reactions at all? Starting with you, Professor.
Let me start.
Yeah, please.
On what to do. Look, what to do from central banks or for financial regulators is not simply playing with the interest rates. For instance, several examples of vulnerability spots that I mentioned. Some of them could be tackled by the action of regulators in specific things. For instance, non-financial corporate debt. The requisites in terms of ratios of assets vis-a-vis debt and so on, they can establish cap, they can stimulate, they can, let's say, help manage the speed with which the indebtedness is taking place. One problem with this is partly a response to the other question about do we have a global monetary system or not. I would say, yes, it is a dollar-based system, but it's global. It's global in the sense that there are some dimensions that do not fit into simple country schemes. If you don't have a coordination among the countries, among regulators, about those indicators, about those ratios that comprise the regulation, you create a scope, a big scope for arbitrage, for happening the same thing that happens with taxes. If you, before the world has significant economies, before they have some sort of coordination on tax policies, we'll have what we have nowadays, which is this tax evasion. A similar thing happens in finance. if we don't have a minimum harmony on the action implemented by monetary regulators. So there is a huge scope of coordination which can be tackled. And the same thing I mentioned, the non-financial corporate debt, but the similar reasoning can be applied to institutional investors, pension funds. And as I said, in this repo market that I have been hammering, it's connected. The whole dollar-based non-US bank that provides credit and trade finance from Germany to, not necessarily, I will not refer to Germany, but who give monies to sub-Saharan African countries, even if not done by US banks, it is done with hedging vis-a-vis the dollar. So they are connected. And a minimum of organized action is necessary. On the crisis, very briefly, look, the history of trying to answer the question about why the stock, why don't you guys do something? It's an eternal race in any capitalism. It comes with capitalism, with the good things and the bad things. One of the bad things is the following. We'll always have, since the tulips in Holland, a race between the markets, innovative, creating new risks, circumventing regulation, and the regulators, with usually the regulators coming only after. The things that I'm referring to, they were not on the score, on the screen 10 years ago. Many people thought that by simply upholding the banks and let's make the big banks be obliged to hold only US treasuries. So then we'll have a safe system and let the guys play with risky applications, but the banks will be safe and will be safe. And what has happened? The banks have shrunk, and a whole new system has been created, emerged, surrounding it, a new one through shadow. And we will deal with it only afterwards.
Right. Thank you.
I want to emphasize one point, which also links to the issue of transparency and how to deal with corruption. Because if we look at over the few years, capital flows have been to emerging market have been flowing and have been also supporting additional borrowing. So if we look at the medium external debt in emerging market economies, in 2008 it was 100%. Nowadays it's more than 160%, and in some countries 300%, which is as a percentage of exports. So this means that there is more money flowing into the emerging market. Now, you mentioned the management issue of the debt. Yes, that's a key point. Today, you raise debt or you issue debt, but then where the debt goes, nobody knows. So they say it's on budgetary expenditures and projects. But then is there an institution who is managing and saying where this money really goes and what are the different contributions to the real economy and to the overall economy, to the society? Nobody knows it. So it's all broad discussions, but then practically speaking, there is no clear information or transparency on where this money goes. So the more money flows to the emerging markets, the more the possibilities to have some politicians or whoever they're involved in the contracts and so on and so forth, channeling the money into, say, tax havens that nobody knows where the money goes and so on. So this is extremely important. And nowadays, for example, just take the case of Europe, where I am acting here as a chair as a chair of the banking stakeholder group. And now the European Banking Authority has the mandate to follow corruption, I wouldn't say corruption, is anti-money laundering and aspects related to terrorist financing. It's all linked. And I think up to today, I believe that corruption is not put under this umbrella of anti-money laundering and terrorist financing. I think it's important to touch it into that point, so to put the definition there, and then try to manage over time this, I would call them the illicit flows of money, where it goes, and then everybody has to be accountable.
Professor Scicluna.
From a policy point of view, especially in the European Union, we group all these issues of transparency and similar under a big box called reforms. So we are very aware that besides monetary policy and fiscal policy, there are reforms, and that's where risk reduction before risk sharing is discussed, because they are very, very relevant and they prevent. And this is also, one can expand this, and the elephant in the room is that why should, I mean, a lot of this, I called it firepower, is being used or wasted, for example, to compensate for the trade tensions which exist. So what should you do? I mean, should you put the burden on monetary policy, or should we, as we will be discussed later today, get the bull by the horns and say, if these are causing, the slowdown, especially in the manufacturing, vehicles, machinery, and so on, calculated by the IMF at 0.8 of 1% fall in the GDP, caused by trade tensions, rather than wasting whatever is left with monetary policy, you should attack the problem at source, which is trade.
That's interesting.
And multilateralism.
And that's
and
trade. That's an interesting point. I'd like to ask him, just prepare to ask a question, but first let's go to the gentleman at the front. If you can briefly introduce yourself and make your point.
Yes, of course. I'm Sérgio Guzmão Chodowski. I'm the president of the Development Bank of Minas Gerais in Brazil. We are a regional development bank, government-owned. My question to the panel is the following. What role for development banks? I'm not talking only about the multilateral development banks, but also the national development banks and, of course, the regional development banks. And my take on this is the following, is execution, right? I mean, I believe that development banks, and this is my take, I just want to see your reaction, have a role in project preparation, in mobilization of private capital, and I think it has a role also in bringing confidence and also in some way creating new asset class that this liquidity can flow into. And just giving you a very precise example, we are taking advantage of low interest rates in Europe, and I'm taking on-lending programs with the European Investment Bank and others, and mobilizing this capital and doing, of course, hedging into local currency in Brazil, and it's working quite well. Thank you.
All right. Thank you very much. I'd like to come to you, sir, and then just introduce yourself briefly.
My name is Mubarak Lou. I'm from Senegal, and also I am a senior fellow at the Police Center of the New South. Nobody wants to talk about countries. Senegal is among the countries that IMF consider as a country with a viable and sustainable debt. Our indebtedness is around 53.5%, and our community asks us not to go beyond 70%, so we have some margin. Even this year, we have received a lot of investors from the international area, but we told them that we will not issue debt at the international level. So 2020, no Eurobond. All our needs will be funded through the regional financial market, which is West Africa Economic and Monetary Union. So it will be in the local currency, franc CFA. So
that makes a big difference, whether it's local debt or foreign debt.
Exactly. Thank you.
Yeah, interesting point. This gentleman here has a point.
I just wanted to know one thing quickly. One, a new financial crisis, how will it affect the dollar as a reserve currency in the world? And second, the fact that we haven't had any changes in global governance of these institutions. A new financial crisis is going to deteriorate them even more or not? In the sense that, the players, the new ones, are not effectively participating as much.
All right, thank you very much. And one more question. Yeah. Go ahead, sir.
Uida Douche, Policy Center for the New South. So I just wanted to say, you can always have a financial crisis. Doesn't matter what the financial system is like, just about, because in the end, the issue is confidence. And all sorts of things can cause a loss of confidence in a situation of high leverage, loss of confidence will cause a financial crisis. So that's clear, okay? We all understand that. I have specific questions of the panel. The first is, what specific measure are you advocating, would you like to advocate, in order to strengthen the resilience of the global financial system? Can you be specific? Like, for example, raise the capital requirement of banks above 10%, whatever it is. Can you be more specific? And the second is, forgive me, but I do think in terms of, when I'm thinking financial crisis, I have to think in terms of where is the unsustainability of the situation. Okay, that's the heart of trying to predict, difficult as it is, where things might happen. And therefore, I'd like to ask a question about countries I'm worried about. In the case of Europe, I'm worried about Italy. Do you have a view on the sustainability of the Italian situation? In emerging markets, I'm worried about Argentina. Do you have a view on the sustainability of the Argentinian situation and how the IMF issue will be resolved? And frankly, at the global level, I reside in Washington, I'm worried about the United States. The United States has now a debt to GDP which is above 100% and has a budget deficit of close to 4%, between 4 and 5%, in a situation where the US economy is expanding. What happens in a recession, and what will be the implications for the system?
Okay, we don't have too much time left. I'm going to start.
So can I quickly come to 2 points here?
Yeah, but I need someone to actually address those questions. Who is volunteering to take those?
I will.
Okay. Okay, so there's a lot of appetite for them.
Right.
So let's start with you.
So I think I want to emphasize a point about debt being domestic or in foreign currency. Because like what you said, sir, if you issue debt in domestic currency, it makes a difference whether you take debt in foreign currency. For example, Japan and China have huge amount of debt in their domestic currency, Japan being the champion in the world. I think it makes a difference. If you have huge domestic savings like China and Japan do, and you have domestic debt, it makes a difference. I think the point about development banks, domestic development finance institutions is a very important one, because the rest of the discussion has been about international systems. I do believe that domestic finance institutions are very important. They perform tremendous service to the countries in terms of development. And you emphasize the critical role of vetting projects. Very critical. Domestic resource mobilization, leveraging foreign savings with your domestic savings. Ratio normally is 3 to 4 times. But project appraisal, creating assets domestically is critical. And I think it links back to the professor's point about what happens to money, that people who are overseas, the point which was raised by the journalist from London, very, very critical. And it's linked to somebody who was raising the issue about Chinese debt in Africa. So I think what you're doing in Brazil is critical, and it should be continued and should be done by more and more countries to have development banks. This is how it started 60 years ago, countries after countries. And I hope more and more countries will strengthen their development banks. This is how development works.
Okay, Mr. Minister, what do you...
No, in the European context, I mean, the country which was mentioned with high risk, it's not just the problem with the risk itself in that country, but also it's keeping the European Union going for risk-sharing measures and you know, just like the European Deposit Guarantee, a Euro bond, and also an unemployment insurance scheme and so on, because Germany insists, and correctly, that there should be first reduction and the level playing field, and then you go for, otherwise there will be the moral hazard question all the time. So it's keeping the EU going forward and finishing the banking union itself, and then after that the capital markets union. So that's the effect of a particular country being weak in the European Union context.
Okay, let me hear from Professor, then I'll come to you.
I would like to give some elements of the answer. First of all, is to have stricter supervisory actions via the use of stress tests for increasing the level of capital for banks and reserves for the insurance companies. So stress test up to today has been a transparency tool. It's very interesting, but it has not yet been explicitly used as increasing the level of capital. But they do it for problematic banks. They do it, but I think it has to be much more explicit, then the market knows it, and then it is clear. So this is one point. And also more generalized use for macroprudential tools. It is extremely also important to link the microprudential and the macroprudential. This is very essential, because then when you see some systemic risks accumulating over time, then you can hit with certain buffers. At least you delay and sort of you prevent. So you mentioned the prevention. This prevention is important. It's cheaper in reality than crisis management, because nowadays, as you mentioned carefully, there is no. I don't know who is going to manage the next crisis, and maybe there would be a new, innovative, collaborative action of all the. But it's very hopeful rather than realistic. So the second point is, again, to enhance disclosure and transparency on debt issuance and where the money goes. There is news, for example, all the green bonds and green loans, everybody knows where the money goes in green projects. More granularity is needed, but there is knowledge now on how to track exposures and how to track the funds, and also implement more prudent debt management practices. And then if countries that are incapable or they need more enhancement of their capacity to manage their debt, I think it's important to enforce their capacity using, for example, regional or bank organizations or the IMF or the World Bank. They are already doing it, but they have to step further effort into this.
Marcus asked a number of questions. Yeah, I wonder.
Yeah, but I want to answer to touch upon the provocative. First, as of now, we have 25% of all bonds in the world yielding negative interest rates in real terms, 25%. Part of which, of course, related to the Eurozone, and Italy is currently financing itself at an interest rate lower than the US. Can you imagine? The Italy that you mentioned. Greece is financing itself with negative interest rates. So there's something odd. You mentioned Argentina. Argentina is already in default. Not officially, because the only thing it's suspended, but technically it's already a default. The issue now is whether it will manage to have a reprofiling, an organized default, or a chaotic one. I, frankly, am among those who don't expect any orderly thing out of it. But it's not systemically significant. Like the frontier markets. The frontier markets, we do seem to have a problem. Many of the countries that cease to receive foreign aid, and they indulge in indebtedness. Is there a problem for the countries? It might be, but not systemically. Systemically, where the issue is and what to do is the following, Uri, in my view. Go beyond Volcker's, Paul Volcker's approach. It doesn't suffice to regulate, to tackle, to domesticate the banks. That was done. That has guaranteed solvent, small, liquid banks. But then you have had a new universe that has developed itself without being regulated in shadow bank, and now it may explode in front of us. On development banks, we face this paradox, a world in which we are awash with liquidity, term premium down, interest rates, negative interest rates, and you have a dearth of infrastructure investment and so on. What's wrong with that? The fact is that if we open up the chain of value of infrastructure in other fixed-term, long-term investments, there are risks there that the private sector, we will find private agents there able to manage and willing to take on, and some others not. So the role for development banks, in my view, instead of do like they did in the past, that it was to substitute, to replace the markets, is to focus on exactly those points of the chain of value where there is no private agent interested in managing those. If the development bank does this, it makes possible the building up of the whole financing structure.
Okay. What about his questions?
See, there is no real change in leadership, in the sense that it's not a matter of the person individually or the nationality of whoever is running the IMF or the World Bank. That won't make any difference. The governance of these institutions is framed by its evolution since its birth. And it is the fact that they were not very much prone to ramping up their size, because that would demand a drastic change in the structure of governance, that the Chinese and the BRICS decided to go on their own. This new financial architecture, it runs an intrinsic risk of fragmentation. And this, fortunately, on the development, long-term financing side, cooperation has prevailed. I am a testimony on how the AIIB and the World Bank are co-financing projects in the Philippines and so on. On the monetary and financial side, there's only one. Even the Chinese, and the BRICS, when they decided to develop their contingency sharing facility, they established a threshold above which, if any of the BRICS countries want to use it, it has to go to the IMF. It's there in the China-led BRICS arrangement.
Okay.
So there is no dramatic change in the structure in that regard.
Let's give my panel a round of applause, ladies and gentlemen. Professor Reem Ayadi, and she's from Cass Business School, as you had. Otaviano Canuto, from the Policy Center for the New South. Harinder Kohli, who is the founding director and chief executive of Emerging Markets Forum. And last but not least, Edward Scicluna, who is the finance minister of Malta. My name is Alan Kasujja. Thank you very much. How's it going, Mark?
Ladies and gentlemen, we will now take a coffee break and reconvene at 11:15. Thank you.